Welcome to the daily update, where I'll go over the action in the market for Wednesday, September 17th, and we'll see how things look for Thursday, September 18th. Well, the Fed came, the Fed went, the market had a roller coaster ride and pretty much finished right about where it got on. And so there really wasn't much of a change. It might look like, this was just a boring day. Well, there was some pretty intense activity, both to the upside and to the downside, before things got done. And so the market had been anticipating this. This was not a surprise. They cut interest rates by 25 basis points or a quarter of a percent. And we're still leaning positive, but there is some weakness coming back in. We're losing a little bit of the short-term positive momentum that we've been seeing. We're seeing some things in the intermediate term that are looking okay, and other things that are actually showing some weakness. All right, so let's go back and talk about what happened. We had a flat open, and not a real surprise there. The futures were pretty quiet before things opened for the day, and we saw more of a negative tilt right after the open. We declined down below S1, 65.96, and then we climbed back above S1. Then we had the post announcement. And so the earlier on action, I don't put as much weight in that because of this huge variable out there. And then the Fed comes out, makes their announcement. We gyrated. We went to the upside initially above R1 at 66.22. That was to the upside. And then the market reversed, which is very common. We got down below S2 at 65.84 all the way down to 65.50. That was the support level, but we were able to rebound up off of that and we settled to close right at the 6,600 level. So, yeah, these round numbers are becoming a little bit more important. We were down just 0.1%, so virtually unchanged, but because we were down, it goes in the books as a down day. We were above average of volume, not by very much, but it still was above average, and we are positive on all three time frames. We're above the 20, 50, and 200-day moving averages. Interest rates gyrated as well, and I'll go through that here in just a moment. And not really any concern about inflation. It was all about the Fed in Wednesday's session and how they're reacting to inflation. And they're concerned because we haven't got down to that 2% level that they want to get to, and it's remained closer to about the 3% level. So they're calling that sticky inflation. It just won't come down. Some of this is getting blamed on the tariffs. And then with statements like, well, yeah, okay, we might see a bump in inflation because of the tariffs, but it may only be a short term or one time type of event. All right, so some comments. The Fed did come in and cut rates by 25 basis points, or to say it another way, a quarter of a percent. And the officials on the FOMC, they're split on the number of additional cuts this year. That's really what the market was focused on. It was pretty much a done deal that they were going to cut rates. And it's like, okay, where do we go from here? There's an October meeting, there's a December meeting. What's going to happen with all of that? So 9 out of the 19 participants projected just one more rate cut. Now, the market's been expecting two. 10 of those did favor two rate cuts, and one signaling no further rate cuts at all. All right, so rate cuts for the rest of 2025. It looks like there's going to be a rate cut and probably two rate cuts in October and then again in December. Now it's like, let's look out to 2026. What's the Fed saying about that? At this point, there's only one that they're seeing off into the future. Then on another note here, NVIDIA, and that kind of really capped things from going up. It was down 2.62% when it was reported that the Chinese government has asked domestic companies to stop purchasing NVIDIA's products. Okay, well, yeah, don't do that, and that can kind of take a bit of a hit on the stock price. Now, we're still looking okay with the short-term conviction. The Stochk RSI wins percent R. They've been on the list for a few days. The CCI 14 chart, shorter term, that has dropped off. The CCI 20 is still there, and the stochastic. So we're seeing a little bit of weakness in these short-term indicators, but they're still leaning towards more short-term positive momentum. Intermediate term, because there's little change, we're still in the +3 standard deviations channel. And we're not too far away from the 20 period moving average, but we're still far away from the 50 period moving average as measured by the boom indicator. And we're still above that 10% level when we measure the 200-day simple moving average and current price. We just want to keep an eye on that. When we've seen fairly significant pullbacks, not the, it didn't shift the overall market. It was just a pullback, both in 2023 and in 2024. Those occurred when we were more than 10% above the 200-day simple moving average. So we're just keeping an eye on that one. And the only change that I made to the overall scenario is that there's still likely going to be a rate cut in September. So 25 basis points in September, that just happened. Another one in October, and it's looking right now that there'll be another one in December, but that's still a ways off and a lot of things can happen. The dollar was up, interest rates were also up. We're at 4.08%, still well off that 4.5% level, but they did tick up. But we're at the lower end of the recent range that we've been in. And we did tick down just one notch with sentiment. We're still positive, but we had been at 58. We ticked down to 57. We're still positive with our trend. Now, the green line is coming down and the red line is going up, but the green line is still above the red line to make it positive. It's still a strengthening trend. It's above the moving average and it's above 20. And with the slight down day, the bias is negative. I'm still keeping the momentum at positive for right now. I could have changed that over positive to maybe mixed because we're seeing a little bit of weakness drifting back in. But when the Fed does like what they did on Wednesday, it's almost all emotion. There's very little logic going into this. You can tell just by the swings in price. And so we'll let things settle down a little bit, let the indicators just kind of tell us what's happening with the market. All right, so we did get some economic data that came out. Total housing starts, 8.5% on a month-over-month basis. That's a nice increase. And when you annualize that, it's 1.307 million, less than the 1.375 million that was expected, and is also down from the 1.429 million from last time. Building permits, and this is also forward looking, especially with the housing market, down 3.7% month over month. You annualize that to 1.312. They expected it to come in at 1.37, so weaker than expected there, and also down from the 1.362 million that was reported last time there. And then we get this every week. The weekly mortgage applications index, this really shot up 29.7%. Last week it was up 9.2%. And then they break it down. The refinance index accounted for 57.7, purchase 2.9%. So folks are thinking maybe interest rates are lower. We're dropping closer to that 10% or the 4% level with the 10-year yield. And that's really what mortgages are pegged to. So to see that coming down, that's much more attractive, especially from a refinance perspective. All right, so here's a chart of the housing starts. And looking at the starts, that's the blue line, still going up a little bit, but kind of leveling off where the building permits are declining. And these are more forward looking. And if we have an idea of what's happening in the housing market, that can have a big impact on the overall economy. And then looking at the housing starts here, where it is dropping down with this annualized look. And then here's the weekly mortgage application. So real move up here. And after we were positive last week, after spending a few weeks, they're actually a little bit negative because interest rates were higher. Folks are trying to jump in and take advantage of the decline. All right, now we look at Isabel Net. This compares the Fed funds rate with the Treasury rate, and this the 2 year. That's a pretty good proxy for what the Fed funds rate should be. And they tend to move pretty close with each other. Sometimes they get a little bit out of line, but they seem to adjust as time goes by. And then buyback payout ratio has been stable during the past decade. So it's the buybacks that are announced and then those buybacks that actually happen. So net buybacks as share of the total earnings overall. And that's more positive. When we see this number relatively high, that is not only confidence in that particular company. Usually, this tends to happen when the stock market is more positive and the economy is doing fairly well at the same time. Then the breadth thrust, and I do go through this, but if you remember way back in last April, we had what's called a ZWAG NYSE breadth thrust. That's still on the books, and that lasts for a year. You can see 252 trading days, 252, 253, depending on if there's a leap year or not. That's the number of trading days. So the breadth thrust that we are working off of right now, even though it was last April, it's still in the background. Stocks rise when Fed cuts the rates outside a recession. Well, we're not in a recession right now, so we'll see if that ends up taking things more positive. And then rising speculative length may raise the risk of tactile pullbacks as positioning tends to go back to the mean, or it's going back to more of an average. And I use the boom indicator to kind of measure something like this with the S&P 500. This is gold, net long managed money on the COMEX. Okay, so we're seeing more money going into gold right now. And then Russell 2000, these are the small caps. We are seeing folks, asset managers and leveraged funds. These are like enhanced ETFs and enhanced mutual funds and things like that. As the Russell 2000 has been improving, and we're seeing some money coming back in. And market pricing of near-term and long-term interest rate outlook. So the 10-year, and that's kind of what I focus on the most, where they're coming down to about the 4% level, but they see it staying above that level, according to Goldman Sachs. And then the market pricing of the Fed funds rate by the end of 2026. So that's what, a year and a quarter away. They actually see it coming down for the forecast to 2.9%. All right, then since we had the retail sales report, we get this chart right after that. We are seeing a bit of a bounce up here, but overall, we've been going pretty much sideways. And that's can be quite often what we see before we do go into a recession. But this really has held up quite well, and we've been going sideways for quite some time without having gone into a recession. Then switching over to a different source where I get these charts, and this is kind of counterintuitive. It's like what what is the contraction of building permits? And the contraction, which means they're going down, is actually going up. If you look at this chart just by itself, you're like, oh, building permits are going up. No, the number of declines are going up. And that's why you kind of have to rethink this when you're looking at this chart. And wage growth divergence, where folks that are in the higher bracket, they're making more money. A little bit of an increase in the middle, but the folks that are making less money, that's continuing to decline. And then this is just the dot plot here. It's the SEP, the Summary of Economic Projections. Higher growth, lower unemployment rate, higher inflation, and more cuts. Real GDP revised up across the board. Unemployment rate unchanged in 2025, lower for 2026 and 2027. So these are just some of the projections that the market latches onto. And they do see inflation being higher in 2026, unchanged in other years. So 75 basis points in 2025. What are they going to cut? Well, they've cut 25 basis points now. If they do another 25 in October, another 25 in December, that will meet the forecast that you're seeing here. All right, and then retail activity. So this is cash equities, net notional by week. Okay, folks are still buying in here. And this is an outfit called Citadel. Their retail clients have remained buyers 19 of the last 22 weeks and structural buyers for the last 20 straight months. Seasonal demand trends suggest buying will accelerate through November. We'll have to see. I mean, if we do get some kind of a seasonal pullback, which again, we're in the middle part of September, which is the worst performing time of the whole year, do you think folks are going to come in and start buying? There will be some that do, but we don't even know if we're going to get a decline. It really hasn't started to materialize yet. If we see a pullback, it's going to change a lot of people's outlook on things. And then volatility risk premiums. Now, I do have a chart that I'll show later on. They remain elevated. And there's a band that we look at on that chart, and we've been above that band now. And basically, it just this is a good time to consider selling options because you bring in more premium by selling those options. That's kind of the takeaway from this one here. All right, here is the chart. So we did drift lower right after the open. I don't count this all that much because we're waiting for the Fed to come out and make their announcement. And then we gyrated up above R1 to the upside. That was after the announcement was made. Then we reversed and went all the way down just about to the 65.50 level. So yeah, here's the roller coaster ride. But by the time we ended up closing, we were very little changed on the day. And we're actually up a little bit in the initial overnight session. So that could be considered positive because the SPY, the market closes right at 4 o'clock Eastern. Well, there's 15 minutes after that where there are options that continue to trade and some ETFs continue to trade. That actually saw a little bit of a bounce right after the close. And doing okay here, but not really showing an awful lot of conviction. Just kind of going sideways with both large cap growth and large cap value. But the lines are pretty much on top of each other by the time we closed. This took a bit of a hit as we were coming down here. Folks were taking some profits in growth, and we actually dropped underneath all of the moving averages after we had been seeing this improving going back to the beginning of September. Is this the start of something? Are we going to see this ratio continue to go down, or is this just reaction to the Fed announcement and it'll clear itself out and then start to go back up? That's what we'll be waiting to see here. So growth was down where value was up. So growth didn't see a lot of favor in Wednesday's session. They were pretty much even with the mid caps where growth was up a little bit with the small caps and down a little bit with value. Okay, so we've been a little bit concerned about the trailing off of the small cap growth to value ratio. And you can see here, the small caps, they really started to jet to the upside, but they closed way, way off of the highs. So we're just kind of range bound right in here, right in this area on a closing basis right now. And we're a little bit concerned as we're seeing the growth to value ratio going down, holding up a little bit better with mid cap growth to value. And again, we closed well off of the highs. And we did close off of the highs, but also off of the lows with the S&P. We're still below the 50-day moving average with the growth to value ratio here. And not much of a change overall. We did drop a little bit, but we're still above the rainbow with this growth to value ratio. A little bit more of a decline, but in the bigger picture, the discretionary to staples ratio still looks pretty good there. And we're coming down with the green line. This is what I mentioned earlier. And we're coming up with the red line. We're still positive. But we're rolling over a little bit with the ADX, but we have not dropped down below the moving average in the short term. Rolling over a bit in the intermediate term, coming down with the green line, up with the red line. But the bigger picture is that this is still a positive trend. And we were just a little bit above average. You can barely see it right here with the number for the average volume for the S&P. So not a real volume spike there. Sentiment, this is again a newer chart looking at gamma exposure where we closed at the 6,600 level. So we're looking at 6,600 and 6,600. They're pretty much even with each other now. So the market is more at equilibrium after what happened on Wednesday. So we're not seeing anything to the downside or to the upside right now, but everything is kind of plotted right around the 6,600 level. Then we came down just a little bit on a closing basis with the VIX. We're also just a little bit below the moving average of the VIX, looking at the open, high, low, close. Wondering still, I've been saying this day after day after day, the VIX is still below 20. We haven't seen a real spike, at least yet. And so that has just not materialized. We've been watching for this ever since August, and now we're getting more than halfway through September, and we have not seen any substantial increase in the VIX. And you can see here the volatility of the VIX, man, it was all over the place. And we just shot up and down, not necessarily a surprise for Fed days when they actually do something and then the market's hanging on what they're saying. But we're right back down to the moving average with the bar chart, and we're just into the moving averages here with the line chart. So we were unchanged with this fear gauge, and we declined just a little bit with this other fear gauge. No real conviction happening right now. We did see the daily chart of the equity put call ratio going up. So we're back to going up with the 5-day chart, but we're still going down with the 10-day chart. So not any real confirmation there. This is the volatility risk premium that I talked about, where we've been above this band now. We tend to be more neutral a lot of the time when we're right in the band, but we've been hanging out a little bit above this. And that's why if you buy options, they're more expensive right now. If you sell options, you bring in more premium for selling those options. Advanced decline line just kind of up a little bit here based on price, a little bit, not big changes happening here when we look at volume, but the bigger picture is that we are still positive. We're still below zero with the advanced decline ratio, and we're just a little bit positive here with the intermediate term advanced decline ratio. And this is a little bit encouraging. Even though we're below zero here with the short-term advanced decline ratio, we continue to be above zero when we measure it based on volume. And just kind of chopping around the midpoint here with the advanced decline oscillator and seeing a dropping off of the new highs and not really much of an expansion of the new lows, but we're still going down, haven't quite crossed above the moving average yet with the 5-day chart, and we're just flat to trying to turn up with the 10-day chart. And seeing a little bit more short-term weakness here with accumulation distribution, we're falling below the moving average, but in the bigger picture, this is still positive. And we're back to looking more positive when we look at the Chaikin money flow. It's been really bouncy lately. We have an up day, a down day. It's switching back and forth from positive to negative, but we're still negative with the Chaikin oscillator. It's below its moving average and declining. And we're positive with the vortex, but we're seeing the green line coming down and the red line going up slightly. We're still above the moving average with the NYC common stock. So the broader market, at least according to this, is holding up a little bit better. We're right about on the moving average with the S&P, where we're seeing more weakness starting to come into the mid caps and the small caps. This is still looking good though. The 5-day moving average of the highs and lows across the broad market, it's continuing to go up. Now it's a little bit slower because it's a 5-day moving average, but this isn't really showing much weakness at least yet across the broad part of the market. And we ticked up just a little bit with those stocks in the S&P above their 20-period moving averages, but we're still below 50, so it's still negative. A little bit of a tick up above 50 with the 50-period moving average steady, a little bit of a tick up with the 100, and we actually declined a little bit with the 200-period moving average steady. All right, here's the daily chart. We broke down below this pivot point, but we were able to get back above that and close above it, even though we were virtually unchanged on the year on the day. And down at the bottom, we're just barely above the moving average when we're looking at volume. So not much of a change here. The 20 ticked up a little bit, as did the 50, and we're pretty much flat with the 200-period moving average on the S&P. We are declining, but still extreme with the Stochk RSI and Williams percent R. The CCI 14 did drop out of this extreme reading here, and we are declining, but we're still extreme with the CCI 20 chart. A little bit more short-term negativity with the short-term stochastic, rolling over a little bit and still extreme with the intermediate term, rolling over but not below the moving average with the long short-term stochastic. Okay, and we declined here, but we're still above the midpoint with the force index, and we're still green, so that remains positive. And a lot of gyration here with the daily bar, but we're still going up with the short-term trend based on 20 periods. Still a little bit into the +3 channel with the standard deviations chart. Declining, but still above zero with the balance of power. So this has been kind of chopping around. It picked up more weakness than strength. And declining, but still just barely extreme positive with the CMB composite. The go no go is still positive with the dark blue bars and still coming off of the blue line, which is the highest high value. And we're on day 96 now of this trend according to the Landry light system that it started right back at the beginning of May. Also still in an uptrend with the proper order chart. TTM squeeze continuing to improve. The lighter shade of blue here, and it's continuing to go up. And just hovering along like we have been now for months with the ease of movement, just barely above zero. Little bit of a tick up here, but we're positive in the bigger picture with the Arun. There's still more buyers than sellers. And we ticked up a little bit with the S&P McClellan oscillator, but we're still below zero. So we're declining here based on price. Now we're starting to turn down just a little bit based on volume. So we'll have to see how Thursday plays out. Are we going to see any positive or negative conviction that might give some more direction to this indicator? And we're dropping just a little bit below zero with the NYSE McClellan oscillator. So again, very choppy lately, going down a little bit based on price and volume. And again, a mixed picture here. We're going up based on price with the swell trading oscillator. We're declining based on volume. Momentum is still trying to improve. Now that's slower and it takes a little bit of time for this to work out, but the PMO is actually positive. It's crossing above its moving average. But when we break this out based on price, we are declining below the moving average. We're right on top of the moving average when we look at volume. And so not much of a change here. We're still below 50 with the PMOs that are rising. The buy signals are decreasing below 50. A little bit of a move down here with the PMOs that are above zero. But then we look at the oscillators. The short-term oscillator, we're above this green line. We're above the moving average. That is positive. We're still positive with the MACD, which is short to somewhat intermediate term. So the short and intermediate term indicators are actually turning positive, and we're turning up with the two long-term momentum oscillators. Copic curve is also positive now, and we're no longer really extreme here with the Shine trend meter. A little bit of a decline there, and no longer extreme with the money flow. We fell down out of this extreme overbought signal territory, and when we come back down, that's when the overbought signal is actually registered. But we're still above 50, but the context is that this has now declined over the last couple of days, and we actually went up just a little bit, and we're positive with the ultimate oscillator. Declining, but still above the moving average with unbalanced volume. We're not extreme anymore with the short-term RSI. We've dropped down below 70. So that's a short-term overbought condition that has now been registered. We're still positive though, and we declined a little bit with the intermediate term RSI. And we came all the way down to the 10-period simple moving average. That was also helping to provide some support, and we closed up off of that even though it was a down day. Intermediate term trend, we're still going up with the red line and the blue line. That's still holding up for right now. We're above all the plotted moving averages. We're not too far away from the 20-period moving average now. We dropped down below 100 with the boom indicator. We did decline with the 50-period moving average study, but we're still above this 200 level. And we're still more than 10% above the 200-day simple moving average with the S&P. This is just where we want to watch this. When we had really high readings before, this did precede some kind of a decline after that. And we've gone from positive to neutral with the Elder's Impulse system, but we're still positive with the parabolic SAR. Really choppy now. I'm still counting this as negative. We're still below the moving average here with the bullish percent index. Not much of a change, but still positive since we're above 50 with the NYSE bullish percent index, and a little bit of a tick up here with the NASDAQ 100 bullish percent index. And we look at our support and resistance. We're still above this R1 pivot point. And again, as I've been pointing out, this won't be official until Friday's close since this is a weekly chart. But this still looks pretty good here for the time being with these weekly bars showing a series of higher highs and higher lows. And we're still up at the upper end of this trend channel, actually trying to break a little bit above it. Then seeing a little bit of a weakness developing here with some of our trend charts. This is more of a doji type of candle where we're turning black with the Heiken Ashi. That's leaning a little bit more negative. We're positive with the Keiki chart since it's black, but now it's pointing down. If it was pointing up, then it would still be positive. But we're still positive with the Renko chart and the three-line break chart. Long term, a little bit of a tick up here with the 150 and 200 period moving average steady. And then still positive across all time frames. I mean, we're getting these really small closing values, and so we're not seeing a lot of changes across the different indexes and time frames that we look at, where the dollar is still continuing to be negative across all the time frames. And it's kind of hard to read much into this here. It's good that the financials that was the best performing sector, but then staples were good, and then right after that, well, even though it was a distant third place, was communication. So I wouldn't take a lot away from this in Wednesday's session because there's a lot of emotion behind all these moves. So the Dow did set a new all-time high. It didn't close there, but it set it and it got above 46,000, where we had a BPI cross above 70, and then the Nasdaq dropped below 22.2 and then dropped below 22.1. The euro has really been going up against the dollar, where now the dollar is setting a 4-year low. Canada just seems to be partying on day after day by setting new all-time highs. And let's see, here's Nvidia getting hit because of the Chinese news. We had both Google's down just a little bit there. Amazon was down, Tesla was up. So not any real strength, but we did see improvement in the financials though. It's still not helping the longer term ratio, but you got to start somewhere if we're going to see some improvement. And you can see a lot of green down here in the staples area, which is more defensive. So here's the Dow intraday set an all-time high, but not a closing high, and positive after being neutral with the diamonds. And we came down not quite to this R1 pivot point here, but we did close up well off of the low with the NASDAQ. But now we're neutral after being positive with the NASDAQ. We did hold at this support level here with the NASDAQ 100 and closed up off of the lows there, even though the NASDAQ 100 was down. Also neutral after being positive with the Qs. Momentum is still positive for the NASDAQ 100. We're still above this trend line going back to 2009 with the NASDAQ 100 weekly chart. And you can see the small caps. It looks like they were just getting ready to bust out to the upside. Now, it's still a higher high and still a higher low here, but it closed way off of the highs with the small caps. Also, way off the highs here with the Russell 2000 small caps. And it's just really crazy how this looks. Still neutral though with the small caps. Looking at the Elder's Impulse system, also well off the highs with the mid caps. Did not break out and set a new high on an intraday basis. And neutral with the Elder's Impulse system for the mid caps. Down but virtually unchanged with the Wilshire 5000 and the total U.S. stock ETF. We were up almost 1% with the financials. Now, again, looking pretty good all by itself. Little bit of a tick up here when we look at the ratio between the financial sector and the S&P, but we need to see more follow through with this for this to turn back more positive. And we were down over 0.5% with the FANG index. So Amazon was down over 1%, still above its 50-day moving average, generating a golden cross now with Apple. It was up 0.35%. Above the 50-day moving average with Meta, it was down 0.42%. Microsoft up just a little bit, pretty much at its 50-day moving average, and Google dropping a little bit more, but in an uptrend after just going parabolic there for a little while. And Nvidia getting hit and dropping under its 50-day moving average, with Tesla up over 1%. And this is helping discretionary to perform better. And Netflix up 2.33%, trying to get back above its 50-day moving average. So still seeing a fairly strong correlation in the short term between US and world stocks, a little bit of an improvement with the longer term correlation. And we were down slightly, but we're still more in the mid part of the 60s here when we look at oil. And we just are falling off a cliff again here with the dollar index. So we came back up with the 10-year yield, and we've kind of been range bound here. But we've been testing this 4% level, and we come down and then we come up off of that. We actually dropped a little bit below it on Wednesday, but then pretty much closed at the high for the session. And getting a little bit choppy here with the 10-year based on price. So still looking okay with the Qs to S&P above the advancing moving average, and discretionary to the S&P is holding up. Came down a little bit, but still above the advancing moving average when we compare large cap growth to value. So with the large caps coming down, but still above the moving average, mid caps a little bit of a decrease there. Small caps are showing a little bit more weakness. We're still below a declining moving average. So what's the outlook then? We're still positive, and I'm still calling this overhead resistance on that weekly chart. And again, it won't be official until Friday's close. And we're going to get initial as well as continuing claims on Thursday, the Philadelphia Fed Index and the leading economic index. And then anything geopolitical that may happen, but it's all kind of focused on the Fed right now. A few weeks ago, it's like, the Fed, what's the Fed? They don't mean anything anymore. Well, now the market's really focused on that pretty much. And then also be reminded that in Friday's session, there will not be any economic reports that will be released. And here is a look at the calendar for Thursday's session. Seasonally, though, not much of an edge either way. Neutral to positive with the Dow, but neutral to negative with the S&P and NASDAQ. Going back to 2002 for September 18th, we are in options expiration week, where historically, going back to 1980, We have been up 55% of the time and down 45% of the time. But then the week after, we see just a reverse of that, where we're down more than up. And here is one more kind of positive day according to the Stock Traders Almanac chart before we do see some more seasonal weakness. We don't know if it'll play out this way. We really haven't been sticking to seasonal patterns as far as declines, but we'll see. Is this going to feed into something as we start to finish out the second half of September? Also, this shows where September is weak. This also shows where September is weak. Second half of September, the worst performing half month of the year. This also shows seasonal weakness that really has not started to develop yet. And this also shows the performance of September going back to 1950, which is not all that positive. So we now have our three smart money indicators on the negative side here, where accumulation distribution in the bigger picture is still positive. But the boom indicator, shorter term, that is now turning negative. We are positive with the Chaikin money flow, but we're negative with the Chaikin oscillator. And now we have both the NYSE and S&P McClellan oscillators and summation indexes, which are negative. And the bullish percent index for the S&P, we're getting a mixed signal with the Swindler trading oscillator. And let's see, on the positive side, we're still looking okay with the growth to value ratios. The discretionary to staples, that's actually been one of the stronger ratios that we've been watching. The parabolic SAR is positive, and we're positive with our momentum oscillators. And because we're above 50, and we actually went up with the NASDAQ 100 bullish percent index, but we're above 50 with the NYSE bullish percent index. And then our secondary indicators here, ease of movement, money flow, and ultimate oscillator are positive. The vortex, it's a primary indicator. That's why it's in gold. It is still positive. And the momentum for the NASDAQ 100 is still positive. The financial sector, again, I say this over and over, when you look at it by itself, but still underperforming when we compare it to the S&P, and then the long-term oscillator that we call the special K, that is positive with the daily chart and weekly chart. All right, and then here are the pivot points for Thursday's session. So our conclusion, really, I didn't change anything here. We're still positive on all three time frames. We're still above what I'm calling overhead resistance. Can it hold? And that will be official in Friday's close. We are still looking mostly positive as far as conviction in the short term. If we do decline, we'll be watching the 20-period moving averages. And the intermediate term, we're seeing some things that are holding up and looking better, some things that are actually showing some weakness. And then we're positive in the long term, but we're 10% above the simple moving average. So we just want to be aware of that. So thank you. I hope you found this helpful. Have a really good day, and I will talk to you in the next video.